According to the latest Ulster Bank PMI survey, Northern Ireland firms reported their third successive month of falling output in February. Beneath this headline, however, there were some signs of improvement relative to the previous month's survey in January. Back then, Northern Ireland's firms reported a simultaneous fall in output, new orders and employment, with only the service sector in expansion mode. However, the February survey has reported a return to growth as far as new orders are concerned, and firms also started increasing their staffing levels as well. Furthermore, the construction and manufacturing sectors have returned to growth after their brief period of contraction. To date, the only sector that has reported a sustained period of falling levels of output and employment has been the retail sector. Local retailers have been reporting falling sales since September of last year. Clearly, with sterling trading at its highest level against the euro since late 2007, this is filtering through in terms of retailers who are experiencing low levels of cross-border trade. Up until now, the services industry has been the only sector to avoid the stagnation or mini contraction that we've seen in recent months. However, in the latest survey, service sector firms in Northern Ireland reported a sharp reversal in their fortunes, with new orders and business activity falling for the first time in 20 months. Employment growth across all sectors bar retail is the most positive aspect of this latest survey. Northern Ireland's private sector firms are still increasing their staffing levels at a rate that exceeds the long-term average prior to the downturn. Encouragingly, there is no sign of a slowdown in terms of service sector employment growth. Disinflation and deflation are key themes in all economies at present, and these trends are also evident in Northern Ireland. Northern Ireland's private sector last month reported no rise in input cost prices for the first time in 6 years. Northern Ireland's manufacturing sector also reported its first fall in input cost prices for the first time since February 2009. Clearly, with falling oil prices and the strength of sterling, this is leading to falling input costs. However, this does not necessarily automatically translate into increased profit margins. Indeed, local firms are having to reduce their output prices and discount for their price of their goods and services at an increasing rate. Indeed, if we look at the manufacturing sector, it is reducing its prices at its fastest rate in 5 years. Once again, the latest survey is something of a mixed bag. However, the overall tone is more positive than the previous month's report. Manufacturing has returned to growth, so too has construction, and the rate of employment growth has been accelerating and represents robust rates of employment growth. However, the key concern remains the continued divergence in the recovery in Northern Ireland relative to that of the UK and the Republic of Ireland. Low inflation will act as a strong tailwind for households in 2015. However, this will be offset by headwinds stemming from the forthcoming public expenditure cuts and also the unfavourable sterling-euro exchange rate.